Good morning, YouTube. Today is Tuesday, June 27th, episode number 45. We're dubbing this one the Donald. Good morning, boys. How are you? Cheers. What's
Good
going
morning.
on?
Good morning, toast. That's a good dub.
Anthony's got the aviary behind him this morning. It must be a beautiful morning. What's going on, big dog?
Not much, man. Yeah, birds are chirping this morning.
It's always good. It's summertime. We got the poll open.
Pool is open.
You won't jump in. You won't go jump in the pool.
No, not a chance.
That'd be an episode.
That pool is.
Yeah, that would be an unbelievable. I mean, it's right behind you, right?
It is. Yeah, the pool water is not warm right now, so I will certainly not jump in.
I mean, turn the heater on, guy.
I got two ahead of myself here.
Oh, we're going behind the scenes.
I got two ahead of myself.
Put the curtain back.
I took a couple screenshots. I was trying to steal those tips. A little Lipera playbook.
Yeah, what was that system there? Great.
Yeah, buddy.
No, guys, I hope everyone had a great weekend. It went fast, like always, as we're heading into the holiday weekend. I guess kind of a weird one, right? 4th of July next Tuesday, but I kind of assume everyone's just going to start the party on Friday.
I think so. I looked to book a tea time on Friday, actually, and the first tea time I could book was 3:45 in the afternoon. So I think everybody's getting started Friday morning.
Unbelievable. Country club problems. I can't believe it. I mean, I wouldn't pay dues this month for those type of times they're giving you.
Yeah, no, I think you're right. Last day of the month, I can't even get a tea time. I haven't even been up there all month.
I just can't believe we're halfway through the year. Like, that's crazy.
That is crazy.
Yeah, seriously, boys. All right, so
That
today
means we're going to get, since we're halfway through the year, we're going to get 46. That means we're getting a whole 52 episodes as Chatterboxing this year. Is that what that means? Or,
did we?
My math's off. I'm just confused why we don't have a full, 104 going. We're only at 46 halfway through the year.
Well, I don't think we started directly at the January 1, Tom.
That was our fault.
We didn't come up with the idea soon enough.
Gotcha.
All right. But today we're here because we're talking mortgage insurance. Mortgage insurance, I would say, is one of the least known items, part of the mortgage payment or the mortgage process. A lot of folks don't know what it is, don't know how much it costs, don't know how long it lasts for, get worked up when they hear about it. So we're just going to go over a quick overview of mortgage insurance, talk about it for the different loan programs, because it is different for every loan program. And it's different for conventional loans compared to government loans. And then there's also monthly mortgage insurance, and then some loan types have upfront mortgage insurance or a guarantee or a funding fee that's paid as part of your loan amount. So that can be different as well. So we'll get into that real quick, and then we'll talk about the Anthony Lipera special, where you can even buy out your mortgage insurance. So you don't have to put 20% down to not have mortgage insurance. You can put any amount down on a conventional loan and not have mortgage insurance. And we'll talk about the expert on that one.
Didn't Mayor Ed Gainey call that the Pittsburgh special? Not the Philly special? He's got the Pittsburgh special from Lipera.
I don't know. That's a good one. Tommy, you must be a dad or something. You're throwing out these dad jokes now.
I don't think so yet.
Okay.
Not yet.
No buns in the oven or anything you need to tell us about?
I don't think so. I got a dog. She's at Grandma Pap's today.
Okay. I saw pictures online of Belle causing havoc in the office, per usual.
She definitely caused a fight. Took out this little dog, Sadie. Sadie was fighting back, though. So,
Yeah.
And then yesterday she had a day with the doodles. She ran too much. She threw up.
Okay.
She got a little overheated.
Oh, perfect. That's a perfect segue for you to start talking. Let's talk FHA, VA, USDA. Where do you want to go with this, Tom? Government.
We'll We'll start with the VA. VA loans, they are, I believe, the best loan type, because
Most
they are.
beneficial to the buyer. How about that?
Yeah, I couldn't get the words out, but yes, as it should be, as they protected our country and their veterans. So the MI on the VA loan there is none. So on the monthly payment, there's no MI for the veterans. They do have to pay a funding fee, which is in the beginning, and we will get that funding fee number off of their certificate of eligibility. In most instances, for the first time use, we're looking at, now correct me if I'm wrong, because I believe they did just change this. It was 2.15 for the no down payment on the first use.
I believe that's correct. They do keep changing it on us, though. It was higher than that, and they brought it back down.
I think it used to be 2.3 for the first time use, and if you put 5% down, it was 1.65, but now it's 1.5. So they did lower those a little bit for the veterans, but if they are exempt, you would not need to pay that funding fee. So veterans definitely have the best way with MI. The next one would be USDA. They actually have the second lowest MI field, which theirs is 0.35% within the monthly payment, as well as they're going to pay 1% of the loan balance as their guaranteed fee, I believe it's called. So they have the second set of MI and the second lowest. The VA is the lowest.
Let's break that down for a second, Tom, because we just did a lot of mortgage talk there. So government mortgage insurance is set no matter what your credit score is, and that will differ from conventional, and we'll talk about that in a second. So that's why a lot of times for government loans, if you have a lower credit score, they can be more beneficial because the mortgage insurance doesn't go up and your lower credit score doesn't affect you. But so USDA sets that percentage. It is 0.35% for the monthly rate. So no matter where you go, no matter what lender you use, if you get a USDA loan, or when we talk FHA loan next, it's always the same no matter what.
Yeah, you do an excellent job of calming me down. I get all excited talking mortgages and start throwing out acronyms.
It's that Penn State in you.
I get yelled at for acronyms all the time. So, and then the last one is the FHA, which also has the set monthly mortgage insurance. It's either going to be 0.55, which they just lowered from 0.85 a few months back, 0.55 for the monthly payment, or if you put 5% down, you can get it down to 0.5. So FHA mortgage insurance also is going to last life of the loan unless you do put down 10%, where it would only last for 132 months or 11 years. So FHA mortgage insurance is a good option because Ryan's going to talk conventional, and you'll see how that 0.55 could double on a conventional loan for somebody with a little bit lower credit score.
Yep, exactly. So again, though, everyone gets worked up life alone, right? Oh my God, I can't go FHA, I can't go USDA. That I'm going to have mortgage insurance for 30 years. Anth, you're allowed to refinance, right?
You are allowed to refinance.
Yeah. So I mean, when you start building equity, when rates drop supposedly in the future, you can refinance out of those government loans and drop mortgage insurance. Or if you're FHA, put the 10% and it will fall off. But conventional loans, everyone wants to go conventional because of no mortgage insurance. If you put 20% down or more, you do not pay mortgage insurance. That's pretty much the one and only benefit of putting 20% down. Other than that, your mortgage insurance is put into a pricing engine where all the factors of your loan can come into play. Your credit score, your down payment, if you're a first-time home buyer or not, your debt-to-income ratio. And if you have a lower credit score with conventional, where we were saying it's 0.55%, it can go up to 1.2%. In some cases, or 1.05% or 0.99%, where a conventional loan, the buyer is going to have double the mortgage insurance. So as a loan officer, that's when we say, Mr. or Mrs. Buyer, an FHA loan may be better for you than a conventional loan, strictly because of the mortgage insurance cost is so much higher for conventional. So that's what we look into and play with when we look at pre-approvals and what's the best loan type when we're looking at mortgage insurance. But when you get a conventional loan, and I'm tossing it to Anthony here, you also have the option to do what's called buy out your mortgage insurance. And Anth has become an expert at this the last couple of years. He's leading the industry. So we'll let him talk about mortgage insurance buyout.
Awesome. All right. So the biggest reason, if you ask somebody, hey, do you want to put 20% down? The average person is going to tell you probably no. That's a lot of liquid assets depending on the purchase price. But the main reason why they're doing it is because of the bad word called PMI or MI or private mortgage insurance. A client doesn't have to put 20% down to get rid of PMI. And that's kind of like one of those myths where you have to have 20% down to buy a house. It's totally a myth. You can have less than 20% down and not pay PMI. And it's extremely cheap. You're paying a fraction of the cost of what you would pay over time. So to put things in perspective, I did one yesterday. I'm actually going to just share my screen real quick. But I did one yesterday, and the client was actually, I'm going to try.
You had it at the beginning of the episode.
I did. Wow. I don't know what happened to it.
I'll put my screenshot up there.
In 12 to 24 months. Well, that's great as long as it benefits you. It has to benefit because clients don't realize that when you refinance, you're going to pay closing costs again. So why not make the payment work for you now and save some of those liquid assets and, not pay PMI in the beginning. And then, if rates come down dramatically, then, and if it's going to be a benefit, then you can refinance, but you're taking the lower payment option without PMI with saving as much liquid assets as possible.
So I mean, in short, you can put less down and have a similar payment with buying out mortgage insurance. So if you don't want to do the 20% down, you can still put less down and never pay it. Some buyers don't want to have it. They'd rather, like you said, pay that up front where it's going to be cheaper and just go on with life. Now, if you do want to have mortgage insurance, here's a tip for all those buyers out there. If you're sitting in a home right now, no one is going to tell you this, that you're making your payments to. But equity is the best part about your mortgage. The last couple of years, we've had a ton of equity. After 2 years of your mortgage, so if you've been in the house 2 years, you can call up your loan servicer, ring, call them up, say, hey, I think I have 20% equity. I would like my mortgage insurance removed. If you have a conventional loan, they will come out more than likely, do some sort of appraisal or valuation of some kind. If you have enough equity, they can drop your mortgage insurance for you, probably for a very small fee. So if you've been in the house or agents, if you have buyers, if you need a reason to call people, if it's over 2 years, we know in the Pittsburgh market, we've had some good equity in the last couple years, you might be able to drop mortgage insurance as well. So that's all I got. This has been a great talk so far. We went long today. This has taken up the average time, but you guys got anything before we're done?
No.
Make it a good Tuesday.
Absolutely.
Later, boys.
Later.
See you guys.